Friends, welcome back to the channel. Guys, in today's video we're going to go through this beautiful presentation which I've created on the magic formula investing based on the book The Little Book That Beats the Market. And after watching this video, if you stay till the end, you'll have a tool in your hand which you can leverage to generate very huge amount starting from a very small amount, right? You can compound your wealth very fast, especially if you have a small sum. Now, what is that deconstruction of magic formula? So just to give you what we are looking at, Joel Greenblatt, who basically gave us this formula, he's a hedge fund manager in US, and he owns this hedge fund called the Gotham Capital, and his fund has been able to generate returns close to 30 to 50%, right? Between 30 to 50% for the last 20 years and more, right? So this is the kind of compounding you're looking at. So meaning he's compounding his wealth every 2.5 years, right? Compounding meaning doubling his wealth every 2.5 years. So you can just imagine how much of a massive compounding it can lead towards if you hold it for 20-30 years, right? It can basically make us all filthy rich. So what is the philosophy behind magic formula? And magic formula, as we'll see later in the formula, but magic formula basically combines two things: quality and value. So we are buying quality stocks or quality companies at lower than market price or lower than their value, right? And we'll see what are the exact metrics we are using to get these two things. So for quality, we're using return on capital, and for value we are using earnings yield. Meaning earnings yield is just the inverse of the P by E ratio, which is price to multiples, right? Price multiples. So what P by E is basically how much price you're paying to generate $1 return on the company. So if P by E is 50, meaning you're paying $50 to generate $1. So you want to go for companies which are less P by E. And if you just inverse the price to earnings ratio, meaning earnings by price, then you get something called as earnings yield, meaning how much earning you're able to generate for the price. Okay, right? So these are two things which we'll be considering, and later you'll see how we'll combine this in the video. So in the book, you don't have to go through the book if you stick till the end of this presentation, but still you can go through it. So he has given an example of a gum shop or a lemonade stand, right? And considering lemonade stand or a gum shop as a business, how will any business generate returns, right? So any business is said to be good business or profitable if it generates good return on capital, meaning if you're putting in 1 lakh into the business, you should be able to generate something more out of it, right? So it is basically earnings before interest and taxes, EBIT, on the balance sheet, divided by the net working capital plus the fixed net assets, meaning how much of the assets the company has and how much of the capital you're putting in, and based on that, how much EBIT is it generating. So this is the formula for return on capital. If the return on capital is good, meaning it is high, then the business is good, right? It's very simple. How much of earning the business is generating on the capital invested and based on the total value of the asset, right? And in the book he has explained it very simply with a lemonade stand or Jason's gum shop. Likewise, if you have to evaluate, this is the first metric, then return on capital. Now what is earnings yield? Earnings yield is how cheap the business is available, right? So meaning now for generating that earning, how much of the enterprise value or how much of a price you're paying to generate that value, that is the earnings yield, as we discussed, right? So these are two things. You want more high earnings yield, you want this number to be higher, and you want both these numbers actually to be higher, right? So if you were to apply the magic formula to shortlist stocks, what will we actually do? First we have to define a universe, right? So here, this whole formula is based on something called as reversion to mean. So whenever stocks move up, good companies generate value. They don't move linearly up. They go in a zigzag fashion, right? And if they are below the moving average, at some point later in the time, they are supposed to come back to that mean average, and that is called reversion to mean. So we're waiting for the reversion to mean happen basically, and that's when we get out of this business and generate our returns as investors. So the first thing which we are supposed to do is define the universe, right? Which is US stocks having a market cap of more than 100 million. Now in India, you can consider 1000 crores is a good number. 1000 crores if you're from India. You can go to screener and shortlist the stocks. Then you have to rank them based on return on capital, right? And then you have to rank them based on return on earnings yield, and then you have to combine both the rankings, right? So return on capital ranking plus ranking based on earnings yield, and whichever stock is having the highest final score is the topmost score, is the top selection according to this formula. Now you select 20 to 30 of the top stocks and hold it for 1 year and rebalance after every year. So you keep on rotating after every year by this very simple logic. Right, so this is the formula. The verdict. Now, what is the verdict looks like? Now, this formula has been back tested in US for from 2003 to 2015 exactly, right? And Greenblatt's claim is it gave upwards of 30% returns, while the independent backtest for the S&P 500 gave only 8.7% returns compounded annually from the magic formula. I hope you'll find it. If you did like it, do get a thumbs up, do subscribe to the channel if you're new here, and I'll see you again in the next video. Till then, take care guys, bye bye.